Welcome back to Morning Trade Live. It's time now for the big picture. Let's welcome in Collin Martin, Head of Fixed Income Research and Strategy, Schwab Centre for Financial Research. So we're seeing a bit of a sell-off here and a few moving parts. I'm just looking at the latest Fed commentary actually coming out of Jeffrey Schmidt, which has been an interesting dot there, particularly with regards to not agreeing with the rate cut that we saw the previous month, and then once again saying that he's unsure that we should be bringing this down even further, citing persistent inflation concerns. What are you making of all this Fed speak? Because we've also had Kashkari saying that he doesn't support a cut, but really on the fence now. What does this mean?
Well, it means a lot of uncertainty going forward, but it means that there clearly isn't a consensus view about what the next step from the Fed is. It's an interesting point with Schmidt. He was the lone dissent at the October meeting, which I think caught some people off guard. But what we've seen since then, it's been over 2 weeks now, we've seen a number of Fed officials, voters and non-voters alike, talk about the need for a more patient approach right now and a patient approach into 2026. So it's going to be really interesting over the next few months and quarters as we get the rotation of Fed voters. You know, Schmidt, he's a little bit less certain about what he's going to do in December, maybe no need for a cut, but he only has one more vote this year, and then he's off the rotation. So that's going to be very interesting, along with potential new Fed governors as we look into 2026. I think what we can expect, though, are more dissents going forward. We haven't gotten too many lately. Usually it's been one or two when we do get dissents. We haven't gotten many meetings where there's been 3 dissents, but clearly there's a wide range of views on the committee right now. I think it's going to be really difficult for Fed Chair Powell and whoever the chair is as we go into next year to build that consensus. So I think so I think we might start to see more dissents, and that just might result in more treasury market volatility because it shows the actual outlook and trajectory is a bit more uncertain.
Okay, and just very quickly, I mean, what does it mean then for the rates market? I mean, fixed income, because, the market seemed to be now pricing in, at least it was the case yesterday, of less than a 50% chance. So we're not even talking about a coin toss anymore. It's less than that. So where do you see things going from here?
Yeah, well, I think if they don't cut in December, and we think the bar is pretty high because we think the economy is doing pretty well right now, we don't see a need for them to cut. And given what we've heard from officials, it seems like that likelihood might continue to come down. Now that we still have 3 or 4 weeks before that meeting, we're going to get a lot of data, albeit a little bit choppy and maybe not as comprehensive as we'd like once we start to get that government data. But we still have time to really kind of frame out what to expect. But I think what it could mean if they don't cut in December, and then maybe we get the idea that it could be a more extended pause than what the markets are expecting, that would lead to some upside surprises for Treasury yields, especially short-term yields. The markets are forward-looking. They've kind of already adjusted lower in anticipation of those rate cuts. If it seems like this is going to be an extended pause, then maybe you see short and intermediate-term yields rise a little bit to kind of readjust to that outlook.
Okay, good to know. I do want to just switch gears to sort of credit markets and the conversation that has been emerging this week, particularly about these hyperscalers taking on more debt. I mean, there's been a lot of conversations using Oracle as an example around their CDs, that spread surging. Investors appear to see a higher debt risk, or at least credit risk, I should say, in big cat tech right now. What are you seeing on that front as far as some of the spreads when you look across, corporate debt and credit risk right now?
Sure. Well, if we look at it from a big picture, so I'll talk about the tech and hyperscalers. From a big picture standpoint, the markets were generally priced for perfection. Spreads were very, very low, without much room to move lower. So in terms of what your expected excess return would be, considering investment grade or high yield corporates, it was relatively capped. But that means if things kind of took a turn for the worse, there's more downside there. And that's been a reason for a little bit more of our cautious outlook there, just to kind of manage expectations. I think the risk with some of the tech issuers right now is to make sure that these, the scale we're seeing and all this debt issuance to continue growing, building out, including all the data centers, is what does this mean for profits and cash flows over the short term? Will this actually result in stronger cash flows to be able to service that burden in the next few months and quarters? And I think that's somewhat of a risk right now. Kind of adding that together, even though there are risks out there, and even though we think the markets are priced for perfection and maybe a little bit of a cautious outlook, we're not worried that we're going to suddenly start to see a huge uptick in defaults or something that will be systemic to the financial markets, because I think it's going to be concentrated in the very low rated issuers, triple C rated issuers or below, who tend to have very low interest coverage ratios to begin with. When you mention companies like Oracle, you think about companies with high credit ratings, we think that's less of a concern.
Okay, good to know. Always appreciate it, Collin Martin. Thank you so much. Happy Friday. Have a great weekend. Head of Fixed Income Research and Strategy there from Schwab Center for Financial Research.